Something big just happened yesterday. The Federal Reserve made a decision that can completely reshape the Boise housing market and the broader economy. With mortgage rates high and with the economy uncertain, everyone's asking, what does this mean for Boise real estate? And here's a twist. What if the National Bureau of Economic Research declares a recession? Well, you might think this is a bad thing, but it could actually set off a chain reaction that changes everything, especially for buyers, sellers, and investors in Boise. And here's where it gets interesting. Trump is pushing hard for exactly that. While the Fed has been hesitant to lower rates, Trump is playing a strategic game, forcing the NBER's hand to declare a recession. But why? Because once they do, the Fed will have no choice but to lower the federal funds rate, and that could send mortgage interest rates tumbling, sparking a resurgence in the housing market. This could mean cheaper mortgages, more affordable homes, and a new wave of opportunities for buyers, sellers, and investors. In today's video, we're breaking down the Fed's latest decision and what it means for the Boise housing market and why Trump's strategy could actually work in your favor as a buyer, seller, or investor. Stick around because the political maneuver could directly impact your real estate decisions in 2025 and beyond. Of course, I'm Mike Peters with NBER Boise, and today we're diving deep into how these shifts could impact you. But before we jump into the details, make sure to hit that subscribe button so that you stay ahead of the market. Like this video if you're finding it helpful, and share it with anyone you know who could benefit from this info. Also, if you're considering making a move to the greater Boise, Idaho area, please feel free to grab my free relocation guide. That can be found in the description below, or just simply scan the QR code right over here to my left. So let's dive in. Yesterday, the Federal Reserve decided to keep interest rates unchanged at 4.25 to 4.5. In simpler terms, this means the cost for banks to borrow money from each other hasn't increased or decreased. Chair Jerome Powell explained that inflation, basically how quickly prices are rising, has improved but still remains higher than the ideal rate of 2%. Because inflation is still elevated, the Fed wants to see clearer signs about where the economy is headed before making any adjustments. The Fed also announced that they'll slow down how quickly they're shrinking their balance sheet. Imagine this like tapping the brakes lightly instead of slamming them. Previously, the Fed allowed up to $25 billion in Treasury bonds to expire each month, and now they're reducing this cap to just $5 billion starting in April. This approach helps keep financial markets stable and avoids making it harder for people and businesses to borrow money. Additionally, the Fed projects two small interest rate cuts in 2025, each by 0.25%. But Powell cautioned these aren't guaranteed. They depend on whether prices keep rising quickly, how well the economy grows, and how strong the job market stays. If inflation were to remain stubbornly high or the economy keeps doing well, the Fed might wait longer to lower rates. However, if the economy weakens significantly, they could cut rates sooner and faster. Markets like this news, resulting in stocks going up and the yield on the 10-year Treasury bonds dropping, basically investors now thinking rate cuts might happen earlier than previously expected. But the most important question for us here in Boise is, what does this actually mean for mortgage rates and our local housing market? For example, if rates drop sooner than anticipated, it could become cheaper to borrow money to buy a home, potentially making Boise real estate more affordable and boosting housing demand. On the other hand, if inflation remains high and rate cuts are delayed, borrowing could stay expensive, keeping housing affordability lower and slowing market activity. Mortgage rates are closely linked to the 10-year Treasury yield. While the Fed doesn't control mortgage interest rates directly, their decisions strongly influence them. And because of yesterday's announcement, mortgage rates will still likely stay around the high sixes in the short term, as lenders wait for clearer signals about future rate changes. If the Fed does go ahead with two projected rate cuts, mortgage rates could slowly decrease, possibly reaching around the mid-6 range by early 2026. But there's uncertainty. If inflation doesn't ease or the economy stays strong, mortgage rates could remain higher longer. And conversely, if investors start to expect an economic slowdown, bond yields could drop quicker, leading to mortgage interest rates dropping faster as well. So what does this mean for Boise real estate? Well, the housing market in Boise, much like the rest of the country, is in a strange limbo. High mortgage rates have kept some of the buyers on the sidelines, but tight inventory is keeping prices from falling. And here's what this means depending on your situation. For homebuyers, affordability remains the biggest hurdle. With mortgage rates still around the high sixes, monthly payments are still significantly higher than they were just a few years ago. This is keeping demand in check, but hasn't led to a price crash because there simply aren't enough homes on the market. Many potential sellers are locked into ultra-low mortgage rates from 2020 and 2021 and are unwilling to move unless they absolutely have to. This is causing an inventory crunch, making it harder for buyers to find good deals. For sellers, this means that while there may be fewer buyers, those in the market are highly motivated. Homes priced correctly are still selling, but overpricing could lead to a long time on the market. The days of bidding wars and rapid price escalations are behind us, but sellers who price realistically are still seeing strong offers. For investors, high borrowing costs are a challenge, but rental demand remains strong. With many would-be homebuyers stuck in the rental market due to affordability issues, rental prices have remained high, keeping cash flow strong for property investors. Multifamily and commercial real estate investors are watching the Fed closely, waiting to see when borrowing costs will ease before making large-scale acquisitions. So now that we've seen what yesterday's Fed meeting means for housing markets nationwide currently, and right here in Boise, let's dive into critical what-if scenarios. For example, what happens if the National Bureau of Economic Research officially utters the word recession? This is when things could truly get interesting. Economists have been sounding recession alarms for several years now. And interestingly, the U.S. economy did experience 2 negative quarters of GDP growth in early 2022. Specifically, GDP decreased at an annual rate of 1.6% in the first quarter and 0.9% in the second quarter of 2022. However, the NBER, responsible for officially declaring recessions, didn't call it then, partially due to other robust economic signals like low unemployment and continued job growth. Still, several classic recession indicators have flashed clear warnings. The yield curve, closely monitored by investors, inverted in 2022, historically a reliable predictor of recessions. We've also witnessed slowing consumer spending, rising corporate layoffs, and declining business investments, and significant stock market downturns through 2022. These factors paint a picture of increasing economic uncertainty. Yet, despite these clear signs, the NBER remains hesitant to declare an official recession. So, why hasn't a recession been officially declared? Well, it's simple. Political and economic optics matter. An official recession declaration has major consequences, from financial markets to election cycles. The data is being spun, unemployment numbers appear manipulated, and the government is carefully managing the narrative. Historically, recessions have been declared with similar economic conditions, but this time is different. The government is choosing its words carefully, likely trying to avoid triggering panic before it's absolutely necessary. And does Trump and the new administration know exactly what's unfolding with this? You bet they do, and they're pulling strings that aren't entirely subtle. Remember before last month's Fed meeting when Trump publicly demanded the Federal Reserve to lower the federal funds rate, only for the Fed to openly push back? Well, lowering the interest rates isn't Trump's only play to pressure the National Bureau of Economic Research into officially declaring a recession. Here's how he strategically positions the pieces. Take Trump's aggressive tariff policies against Canada as a clear example. Businesses now face higher import costs, which means higher prices for everyday items like electronics, appliances, and even groceries. Companies either take the financial hit or pass these costs on to consumers, temporarily slowing economic growth. Yet Trump and supporters argue that these tariffs will ultimately strengthen domestic manufacturing, leading to greater economic independence in the long run, even if the initial pain is significant. Banking deregulation is another calculated move. Yes, it induced risks, as demonstrated by the 2008 financial crisis, but proponents believe fewer regulations can boost lending and stimulate economic activity. While the risk of volatility is real, Trump is betting on immediate growth benefits outweighing long-term uncertainty. Similarly, tighter immigration policies causes labor shortages in sectors like agriculture, construction, and hospitality. This limitation can hinder growth and innovation. However, supporters suggest that fewer immigrant workers may lead to increased wages for American workers, potentially improving living standards in certain sectors. And lastly, federal budget cuts reduce government spending, immediately affecting GDP. Though cuts can slow growth and hurt public services, Trump argues that responsible spending will lead to greater fiscal health and economic efficiency down the road. While Trump may very well be playing a calculated game by indirectly pressuring the economy on multiple fronts, he is setting the stage for the NBER to have little choice but to declare an official recession. The move seemed deliberate, coordinated, and strategic. So if the NBER stops playing politics and actually declares a recession, just how bad could things really get? Specifically in the housing world, could rising unemployment threaten people's ability to keep their homes? Well, first, let's get real and scrutinize these unemployment numbers. Is the current rate truly at 4.1%? Let's take a skeptical look at the historical data. Today, the hiring rate sits around 3.4%. And here's where things start to get interesting. Historically, every time we've seen a hiring rate at this level, unemployment hasn't been anywhere near as low as the current 4.1% that's being reported. For instance, back in February 2012, when we had the similar hiring rate, unemployment was at a staggering 8.3%. Fast forward a couple of years to February 2014, and the unemployment number was still high at 6.7%. Well, let's dig a little deeper. Let's go back to the housing crisis era. May 2008, hiring rate again was at 3.4%. Unemployment was just at 5.4%. Just 2 months later, in July of 2008, unemployment ticked up to 5.8%. Not convinced yet? In March of 2020, right as the world was hitting pause, we saw unemployment jump quickly to 4.4% at a similar hiring rate. And reaching further back to March of 2003, with hiring around today's level, unemployment was sitting at a solid 5.8%. And here's the real kicker. If history is our guide, and it usually is, today's unemployment figures might just be too good to be true. However, despite concerns about underreported unemployment, current data indicates that mortgage delinquencies and foreclosures remain relatively low compared to the 2008 financial crisis. For instance, in late 2024, the delinquency rate on a single-family residential mortgage was just 1.77%, far below the peak of 8.22% in 2020. This suggests homeowners are better positioned today thanks to increased home equity and more stringent lending standards post-2008. So, if the NBER officially acknowledges that we're in a recession, could it really be as catastrophic as some people fear? Well, most likely not. Even if unemployment figures are worse than what's being reported, current conditions indicate the housing market is in better shape than it was during past downturns. Homeowners have more equity, banks are more careful about lending, and mortgage delinquencies are historically low. So then, what are the benefits that the NBER actually declares that in the US there is a recession? Well, if Trump can force it, the Federal Reserve will almost certainly respond by lowering the federal funds rate in an attempt to stimulate the economy. That's their primary tool to encourage borrowing and spending when economic activity slows down. When the Fed lowers the federal funds rate, it becomes cheaper for banks to borrow money, and in turn, banks lower the interest rates they charge to consumers on loans. While mortgage rates don't move in direct lockstep with the federal funds rate, they are heavily influenced by it. A drop in the federal funds rate usually leads to lower bond yields, which in turn pushes down mortgage interest rates. If this happens, homebuyers could see mortgage rates fall back into the 5% range or even possibly lower and quicker. This would set off a chain reaction in the housing market, affecting buyers, sellers, and investors in different ways. For buyers, this would be a game changer. Mortgage rates have been one of the biggest hurdles over the past 2 years, significantly increasing the cost of home ownership. If rates drop, affordability improves, making it possible for more buyers to enter the market. A lower interest rate means a lower monthly payment, which can make a huge difference in whether someone can afford a home. For example, on a $500,000 home with a 20% down payment, a mortgage at 7% would result in a payment of around $26.60 per month before taxes and insurance. If rates were to drop to 5%, that payment would fall to about $2,147, saving buyers over $500 per month. Those kinds of savings can make the difference between sitting on the sidelines and actually getting into a home. The challenge, however, is that lower rates will bring back more competition. Many buyers who have been waiting for rates to improve will jump back in, increasing demand. If people are competing for homes, prices could start to rise again. That means that buyers who wait too long might find themselves in bidding wars or pay more for a home than they would have if they had acted earlier. Another factor to consider is job security. If a recession leads to job losses, some buyers may hesitate to take on a large financial commitment, even if mortgage rates are more favorable. But knowing that unemployment is higher than what they are currently saying, those that are educated shouldn't panic. Evaluate your job for how recession-proof it is and make your decisions wisely. For sellers, this shift in interest rates could bring more activity back to the market. One of the biggest reasons homeowners have been hesitant to sell is because they don't want to give up their low mortgage interest rates. Can you blame them? Many people are locked into rates around 2 to 4% during the pandemic and do not want to trade that in for a much higher rate. But if mortgage interest rates drop, the hesitation to move could ease. Homeowners who have been waiting for better conditions may finally decide to list their homes, leading to more inventory on the market. The key for sellers will be understanding how much competition they will have. If buyers' demand surges while the number of listings stays relatively low, prices could start climbing again. But if a large number of sellers list their homes at the same time, inventory could rise quickly, keeping prices in check. Pricing a home correctly will be critical, much like it is today. Even though more buyers will be in the market, they will still be price conscious. So, overpricing a home just because demand is increasing could backfire. Sellers who are realistic about pricing and who take advantage of the window where demand is picking up could see strong offers and faster sales. For investors, a drop in interest rates could open up new opportunities, but it would require a careful approach. If borrowing becomes cheaper, financing rental properties, fix and flips, and other investment projects will be easier. Investors who have been sitting on the sidelines due to high financing costs may start looking for deals again. Lower mortgage rates could also increase homebuyer demand, which could drive property values up and create equity growth opportunities. However, there are risks. If home prices rise too quickly due to increased demand, investors may have to pay more for properties, which could eat into profit margins. Rental property owners will also need to watch the job market closely. If a recession leads to widespread layoffs, rental demand could weaken, making it harder to keep occupancy rates high or raise rents. In Boise, where the housing market has been relatively heavily influenced by population growth and migration trends, investors should pay close attention to whether those trends will continue. If people keep moving to the area because of affordability compared to other large cities, rental properties could still perform well. But if economic uncertainty leads to fewer relocations, the rental market could soften. Overall, though, if the Fed lowers the federal funds rate, the biggest winners in the short term will likely be buyers who can lock in a lower mortgage payment and sellers who have been hesitant to list due to their existing low mortgage interest rates. Investors have opportunity, but they will still need to be strategic about how market conditions shift. So, in summary, Trump knows that the Fed isn't going to lower the federal funds rate by his request. He's not going to get the NBER to do it for him by officially declaring a recession. And here's the kicker. While that may sound catastrophic to some, it could actually work out in homeowners' favors. When the NBER calls a recession, it's essentially a green light that the Fed needs to act, slashing the federal funds rate to stimulate the economy. For homeowners, that means lower mortgage interest rates, which could reduce monthly payments and make borrowing cheaper. And if Trump's maneuvers force the Fed's hand and rates drop, homeowners could see their home equity grow as lower borrowing costs fuel a resurgence in homebuyers' demand. And despite the short-term uncertainty, this move could set the stage for a more affordable and stable housing market down the line, benefiting current homeowners who can lock in at lower rates, while also making it easier for those looking to buy. So while the NBER's recession declaration might initially feel like a blow, in reality, it could be the boost homeowners need to ride out the storm and come out stronger. Well, as always, thank you very much for watching. I hope this breakdown helps you navigate what's happening in the economy and in the Boise housing market. If you found this valuable, be sure to like this video and share it with anyone who you might think might benefit from this info. And if you haven't already, please hit that subscribe button and hit the notification bell so that you're constantly in tune with the videos that I do come up with. And if you're thinking about making a move right here to the greater Boise, Idaho area, don't forget to grab my free relocation guide. You can find the link in the description below, or simply just scan the QR code right over here to my left. Well, thank you again very much, everybody, for watching. God bless. And I look forward to the day that I call you my neighbor.